Larry Shover, Chief Investment Officer at SFG Alternatives, joining us now from the CME Group in Chicago. Larry, always great to talk to you. Just firstly, I wanted to ask you about the feeling that you're getting there amongst traders and investors about the Syria situation. What's your sense about this diplomatic effort and perhaps the less likelihood that we'll see any US military strike?
Yeah, well, right now it's reducing volatility in all asset classes. Like, forget about equities for a moment. We're seeing a reduction in volatility in interest rates, foreign exchange, oil, the metals market. So people are feeling a little bit better about that. And let's keep in mind that this minefield that we've been walking through since the end of August includes not just Syria, but other things as well as tapering and who's going to succeed Bernanke. So it seems like all these risks that are known are starting to just get a little bit to the wayside, and people are starting to look to fundamentals again.
And turning to that, looking at the Fed as well and the meeting next week, the taper talk, what's your sense? I mean, is there a sense that maybe we'll just get some guidance from the Fed at that meeting after that week of an expected read on jobs and the revisions downward for the previous months as well for hiring?
Yeah, you're exactly right. It seems like the market is expecting $10 billion a month. It's not going to have a very big effect. I mean, let's keep in mind that the 10-year yields have gone from 1.6 all the way to almost 3% from the beginning of May, and the S&P has also enjoyed a 5% rally in the process. And a lot of this rally in yields, not all of it, but some of it is due to tapering talk, et cetera. So it seems like the market's adjusted to it. I mean, yeah, anything beyond 10 billion would be a shock to the system. But even Esther George seems to think that 15 billion, and she's the hawkish of the group, even 15 billion wouldn't upset the markets too much. But it seems like people have had time to just embrace the notion and realize that it's not going to have that big effect on the market.
Larry, Mark Todd here from FIG. I was on the way in and looking at some notes from UBS suggesting that the tapering might be affected by the debt ceiling conversation that's happening in the Congress and the fact that it's so acrimonious. Do you think that'll have any impact on how they'll go about that debt ceiling versus the tapering argument?
Oh, yeah, Mark. I mean, it absolutely could, and that's just really a splendid point. Something I don't think the traders here are taking very seriously, or maybe they just haven't embraced it yet. But, yeah, I mean, the debt ceiling and all that talk right now just doesn't seem to be taking front and center stage. People aren't taking it seriously enough. They're also worried about tapering, at least they were. So taking the combination of the two and something not going right, boy, we could be in for a big shock to the downside. But it just seems like, at least from the U.S. standpoint, that traders just believe for one way or the other that it's all going to work out somehow in some way, just like it has in the past.
In terms of the rising yields, rising interest rates, what that impact that's having on that recovering housing market too, I just want to ask you, because there's been that cautious Wall Street Journal article there talking about the impact that the rise in rates is having on demand.
Yeah, I mean, it definitely is having a little bit of an impact because, I mean, we've gone up so far, so fast, and it is cutting out some people who otherwise could afford mortgages. But when we look at the bigger picture, I mean, rates are still so profoundly cheap. And, I mean, it's still, the housing market's still underpriced compared to history. Affordability is there. It's hard to get loans. I mean, a lot harder than it used to be. But, yeah, I mean, definitely is cutting off some people on the fringe. But by and large, rates are still pretty darn cheap.
I think they're incredibly cheap. I wish I could have got long earlier. But one of the things that seems obvious, Larry, is this focus on the consumer confidence at the moment, because clearly that was where the property market had to play a role. And I guess, do you think if we can move through the Syrian experience without having anyone having to shoot anything and go into the diplomatic response, do you think that'll be great for the consumer confidence? Because I'm talking to some people in the States now, and they'd just be really keen to not have to go to another action.
Yeah, I think you're spot on. I mean, I think that will be a big boost for consumer confidence. And when you add on the fact that emerging markets are really emerging, we've had 2 really good days worth of numbers coming out of China. Combine that with not shooting anything or doing anything against Syria right now, that's going to be really, really good for, especially in an environment when we're seeing consumers' confidence start to really flow, especially like in the auto sector.
So in terms of strategy then, wanted to get your thoughts. I mean, we've been seeing particularly that oil price falling on these easing concerns around Syria. What's your strategy when it comes to commodities?
Well, right now, I'm just in the last few days got overweight commodities relative to fixed income. When oil specific, I think right now it's probably a very good buy. I mean, most people think I'm crazy, but I think the risk premium has been removed at $107 a barrel right now. There is a production glut here in North America, but there's also supply glut, but there's a production tightness that we haven't seen in a very, very long time. It's going to take a while to work out of the system. So I think oil is a good buy. But overall, I really like commodities, especially copper and aluminum, especially compared to fixed income.
We've got the Aussie US cross here above 93 US cents, again near 3-month highs there. You're also saying buy the Aussie, buy those commodity currencies then as a result?
Yeah, it could be very, very well. It's something that I've been tragically wrong about for the past 6 to 9 months. I just can't seem to get that straight. I mean, it's such a confusing currency. I can't imagine being an importer or an exporter or a sole trader of that currency. But I think the long-term story for Australia is to the moon. I just can't imagine being as cheap as it is for as long as it is right now.
And just finally, quickly on fixed income there, as you were saying, where are you seeing value?
Well, I'm seeing value in emerging market equities right now. I mean, it's something I wouldn't have said for a while, but I start to dabble there. But also, I'm seeing a lot of value, again, on the industrial metals. I mean, we've seen some really good numbers coming out of China and the emerging markets. I think it's a good time to get into copper, into aluminum. It's something that's gotten beaten down for a long time. It's got a long way to go on the upside.
All right, Larry, great to get your insights as always. Thank you so much.
Thank you.